Hundreds of billions flowing into AI demand and chip investments. These billions of dollars of chips are sitting there idle, right? I'm exaggerating a bit, but a lot of them are, with little space to plug them in. It takes years to get access to energy. It's only getting more and more computationally heavy. So I pose a question to the viewers. What if we found these energy intensive computing sites that can be repurposed, right? They need to have long-term available power, some good electrical infrastructure, and high density capabilities. Sounds familiar, right? These are Bitcoin miners.
Hey everyone, this episode is sponsored by Polkadot. Polkadot is the largest community DAO empowering 1.3 million DOT holders to shape the future of the network through active participation. With over 500 applications backed by over $6 billion in shared security, Polkadot's adaptable technology powers a diverse ecosystem from DeFi to AI. Join the Polkadot DAO and be part of that transformation. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. This episode is sponsored by Mantra. The Mantra chain is the purpose-built Layer 1 blockchain designed for tokenized real-world assets and regulated digital assets, offering scalable, high-performance architecture. Positioned as the blockchain for tokenized RWAs, Mantra is onboarding traditional financial institutions into Web3. Join the ongoing OM Gendrop campaign and be part of the future of regulated digital assets today.
Well, welcome everybody. We're live with an episode of On the Margin, recording here on Friday, November 8th. Little special episode this time. Obviously, some of you might know me, Quinn Thompson, on the Forward Guidance Roundup, and joined today by special guest Josh from Parify Capital. And today we're going to discuss kind of all things Bitcoin mining, the AI HPC story behind the industry that's been a big driver of growth, and kind of break down, you know, what we've been pretty focused on as a pretty interesting trade thesis over the last few months. So, Josh, maybe thanks for joining us, and maybe start off with just a little background on yourself and Parify, and anything you want to introduce to the crowd.
Sure thing. It's great to be here and enjoy the episodes you normally put on. So, Josh, I'm on the investment team at Parify. We're an alternative asset management and technology firm fully focused on the crypto space. The firm was founded in 2018 and has backed many of the industry's pioneering projects from the early days. We do operate several different strategies, so liquid, venture, quantitative, with $1 billion plus in AUM, and I work on the investment team across both the liquid and venture sides. And as we'll get into, I've kind of been building out our thesis on what we'll be discussing today. One quick disclaimer, any views expressed are my own. Parify may hold positions in the topics discussed, and nothing that I say constitutes investment, tax, or legal advice. But with that said, happy to get into it.
Awesome. Well, thanks for that. We'll make sure that gets in there. We should be doing this live. We're both in Miami. Or you're leaving for
tomorrow? Yeah, to Bangkok
for the conference. Nice, but that's not a Bitcoin conference. It's a
ETH developer one. So we'll see.
Wow, you can do everything. Well, good. So maybe we'll kick things off. I think we had a brief agenda, but probably just some flow to the conversation. I think main things to cover is going into the overview and landscape of the Bitcoin mining business as a whole, kind of pre AI HPC. And then, maybe we break it down a little bit further into why they've, kind of gotten into this transition to more of the compute side and the opportunities there. But maybe kick us off of historically, and I think a problem a lot of investors have coming into the Bitcoin mining ecosystem is the traditionally unattractive businesses and kind of difficult stocks to underwrite. So maybe dive in a little why that is, and I have some thoughts as well.
Yeah, no, and you've put out some great thoughts on Twitter. I think the TLDR there is traditionally these businesses were extremely hard to underwrite in terms of being attractive as investments from the equity side. And I think the main underlying reason is the exahash growth at all costs model, which existed for several years and still exists in some companies today, where the goal of these management teams was just to grow exahash. And the problem was there's two sides. One is the financing. So after several of the ASIC or Bitcoin collateralized loans went belly up, why tremendous asset fall on the Bitcoin side and really fast replenishment cycles, aka rapid depreciation on the ASIC side, these companies tended to resort to equity-based financing. So if you've heard of ATMs, but you could think of that as dilution. And I'll give you a stat, which is based on Q2 earnings. But if you look at the kind of major Bitcoin miners, the average increase in share count year over year from Q2 was roughly 62%. So some of these companies are
Q2 23 to Q2 24.
Yeah. So they're just issuing shares.
It's like an altcoin.
Yeah. Well, at least with altcoin, you can see it on chain, right? With these, a lot of times you're getting the information every quarter or through specific announcements. And so it's a lot more of a gray area. But the basic takeaway there is they're diluting. Now, dilution's okay in some contexts if you're, producing real business and enterprise value that's more than the dilution, right? The problem is a lot of this funded growth was unprofitable. And if you look into the economics of miners, specifically, and this is a point of contention, when you factor in the cash cost on the CapEx side of like buying these machines, we've seen that a lot of them are actually net losing money on a cash basis. Like you can make cash if you buy a set of machines and kind of hold there, but if you're continuously reinvesting in these fast replenishment cycles and hash price is a killer, it's extremely hard on a unit economics basis, cash wise, to be profitable. And so you're diluting, but you're not getting much of an ROIC for it. And that's just, not as much of an attractive business profile. So that's the general high level as to why it was hard to really underwrite Bitcoin miners. There's other components like the lack of standardized metrics, general issues with visibility into what's going on in some of these companies. But I know you've kind of spoken a lot about it too, so feel free to add.
No, you covered the big points. It's interesting. I started going really deep on the miners kind of late 21, I would say, around, we had, I think it was a record year for SPACs and going public. A lot of the miners either IPO'd or direct listed or went public via SPAC, in that boom in 21. And it was a pretty, the bulk of public crypto companies, I would say, are mining related. And it was really good for the industry in terms of their access to capital. They were able to get, public equity issuances, convertible note issuances, and even some of them got some debt. And, you look at like a Core Scientific, today, how drastically different that business is from in 21. They went public via SPAC and were straddled with debt. I mean, it was just such a just unworkable capital structure from the second they went public. And so these really were tough businesses. They had that brief window where they had access to capital, but then as soon as, crypto peaked in late 21 and interest rates started rising significantly, it was a double whammy of the IPO window and capital markets windows closed shut for everybody. And on top of that, you have Bitcoin prices tanking, which, gives a pretty big hit to their revenues. So, we saw just kind of utter pain into late 2022 and even throughout a lot of 23 where revenues are declining because price is low, costs, are kind of track inflation with the cost of energy, they're rising. And then as a business, you've already invested all this money into, there's a lead time, right, to build the infrastructure and the sites and order the machines. At that time, the machines were taking 6 to 12 to 18 months to arrive. So you'd already paid for your machines and they're coming. And so when you get those delivered, your incentive is to put it online, which the more than increase rate. And it's inverse, right? The more mining kind of compute towards validating the network, then the profitability per, measurement of compute megawatt or exahash it decreases, which is the hash price. So I think what I didn't truly understand like until really deep diving it, like in kind of early 22, was how just like they're not really profitable. Early Bitcoin mining was super profitable because you had this extreme discrepancy between rapidly flying price and like no one was doing it. So the profitability per unit of electricity, but it got bad pretty quick. And particularly in, after the 2020 halving, it was kind of writing on the wall. And then, you get into a lot of them levered up at the top to buy more Bitcoin. I mean, it was, I'd say a lot of investors, traditional investors looking at the space, have some gripes with the management teams and kind of the experience, I would say, in that front.
Yeah, and then another point too, if you take a commodities angle to it, these supply gluts and periods of or the opposite side of the pendulum, they exist too in other commodity sectors. The problem with Bitcoin is it's actually so much easier to turn on that machine versus like restarting a whole gold mine or something, that the crowding out effect of surplus economic profit is just so much more accelerated. So to what you said earlier, even if there was, let's say, a big bump in hash price, next month, like it would get crowded out like so much faster than the equivalent of gold going up a bunch and then people are trying to restart mines, or maybe it's like oil, right, with the fracking. So that makes it extremely frustrating too, in terms of capturing that surplus that used to exist in the early days, which now gets crowded out at a much more rapid rate.
Yeah, it's funny because I would say that the equities, there's the company side and then the public equity side. They sort of just turned into trading vehicles as like levered Bitcoin because one of the big gripes, I like your commodity comparison. I spent a lot of time when I was in TradFi financing oil and gas and different sorts of energy businesses, and the cyclicality is real. I mean, that's just all commodities. It happens in housing. There's a demand excess and then a massive supply response that, because it requires lead time, it usually results in some sort of overcapacity, hurts unit economics, and the industry producers are kind of suffer for a period of time because of it. And in this case, I don't think anybody really recognized like how difficult it was for an industry. And if you went public in that 21 window, you were kind of saved because you could just keep tapping your ATM despite sending your share price much lower. But there was always like at least a retail bid. But a lot of the companies that didn't get off and were still private either had to consolidate, merge. There wasn't. I mean, there was, or just shut down because frankly their sites were high cost. Like I was always surprised how there wasn't more consolidation in space. But maybe talk about that a little. There is the reason for it, which is like economies of scale doesn't really work, but maybe describe that so people, because that was the big narrative in 2022 is like hash price, is very low, profitability sucks, but there's going to be a ton of consolidation in the industry. And, as we saw with like Core Scientific's earlier model where they were a very high cost producer, like maybe talk about why just like consolidating doesn't work like it would in other industries.
It's a great question. And I think it's still an open question in some regards. Because consolidation would in fact help not just with what you said, but also, a more consolidated business with a higher float, better financials in terms of size, can just from a capital market standpoint have a better profile in terms of the type of capital it can attract. So it even in the AI context, which we'll get to in a bit too, like that would be helpful to have consolidation. I think some of the points, and you've seen like some acquisitions, like you saw, what Galaxy did with some of the Argo sites, for example, what Riot tried to do. I think twofold. One is it's for getting financing. Like I don't know if you're a private miner, you want to take some of this equity from another miner in terms of the quality of equity, and you can't take cash because none of them can really have it. I guess you could try pull an ATM and get it. So the quality of consideration isn't high. The second aspect is, I think it's just being easier in terms of a behavioral pattern to continue to do the ATM, get cash, grow exahash in terms of machine acquisition versus trying to pursue, what Riot did, where you're going to have to work a lot harder to go ahead and acquire a business and merge it in. And there's probably kind of components related to management teams not wanting to do it. So it is a weird phenomenon because from a first principles basis, I did expect it as well, but it seems the avenue of growth that was easier to select from a management point of view was to just keep on issuing shares and buying more machines and growing that way. Again, because it's different to gold or another commodity. It's yes, there are like regional advantages in terms of like power cost and maybe some other factors, but you can like technically just set up machines in different places, and it's not like you have to buy a finite supply or a specific access point, like a silver mine here or something that only exists and has a large deposit there. You can kind of just continue to buy machines, take up a bunch of renewable resource capacity that's just going to waste in like West Texas, and like plug it in and do your chicken coop facility there. So maybe there's some industry characteristics that are holding back consolidation. But it is something that perplexes us as well. And again, like to reiterate, especially with AI HPC, like consolidation of the right companies into a much larger one just unlocks a lot of doors in terms of institutional investor appetite and the type of financing that one could get. So those are some of my thoughts. I think it's still an open question, but let me know if you have any firmer ones.
Yeah, I think that makes sense. And maybe just to kind of circle back for people who aren't super familiar with mining, and after this, I want to transition into the AI HPC side. But before we do that, maybe just like high level, like quick couple points. What in just the straight Bitcoin mining model, kind of forgetting about the AI and even for the companies before they pivoted, what made the top, or let's say higher quality miners stand out from a business perspective? Because I think the one thing that, if you're not a commodities person, if you're used to looking at and evaluating technology businesses or any kind of company, businesses can differentiate themselves from both a sales revenue perspective with the product, but also a cost and quality perspective with the product. And so the difference being with commodities is like, if you're a gold producer, you're producing gold and you have absolutely no differentiation on how much that gold is worth. You're purely at the mercy of the market. Yes, maybe if your gold is located in the Western United States versus South America versus Asia, there's shipping and transportation costs, there's storage and custody costs that differentiate your overall margins. So on the cost side, there's differences. Same with oil and gas. If you're a producer in the Permian, where the amount of time and distance to transport or natural gas resources that you're producing is shorter, you have better midstream pipeline access that's cheaper to facilitate that distribution. Your overall cost to take that base commodity to market is less versus, you're out in Wyoming or some more remote basin and you have to go through an extra 4 pipelines and transfers of, or maybe some tankers to get your product to the market and transact. That's where you differentiate. But you can't say like, well, and there's different qualities of gold, different qualities of oil. But you can't, differentiate. Whereas your Apple, your Amazon, you can create a higher quality product and sell it for more and maybe extract bigger margins. But so for Bitcoin mining, obviously it's the same thing. You're producing Bitcoin and that's what you sell it for. But maybe the other aspects on the cost side, what are the key components you would say that make set a high quality miner apart?
Yeah, it's a good question. And you alluded to it, costs. And then I think the second kind of bucket too is, how you manage your cost of capital. I think there's some teams that are a lot more up to speed and experienced in understanding the different buckets of cost of capital, or different buckets of capital they can access to reduce their blended cost. But to the point of operational cost, I mean, by and large, like energy is the most important one. And there are certain miners that have been able to acquire trapped sources of energy, for example, in West Texas, where at some points they're getting paid to take on this energy because it's just being produced and it's going nowhere. Versus if you're operating in like a competitive market that's close to urban centers, or perhaps, where there's other large consumers of energy like data centers, you're going to be paying much more. And to double click into that, there are some types of power agreements where there are, really good kind of fixed price terms that were used, so you can kind of lock in a rate versus be reliant on what happens with grid demand, which would actually be pretty positive given where we think grid demand's going. So managing the cost of energy and the source of energy, I think, drives kind of a super majority of the economics. We've seen, some of the miners have access to like nuclear, and they can be at a much lower cost per kilowatt versus if I'm just kind of doing the run of the mill grid access in an urban center, it's going to be much, much higher. That didn't matter in the earlier days because hash price versus hash cost was so wide, and things were generally fine even if you were more expensive. As it's become a lot more competitive, shaving off a couple cents on a kilowatt basis really makes a difference. So it's energy. I think the second bucket would be like how you run your machines. We've seen a case or two of poor management of machines that led to a bunch of costly replenishment. So being able to eke out as much efficiency from not just the machines you have, but how you set them up. I think like data center expertise then starts to factor in, like how are you layering out your ASICs? What type of cooling do you have? So all these data center management characteristics would factor into that second component of machine management. And then related to that is like machine purchasing. So theoretically, if you have a phenomenal agreement with Bitmain, you're getting your machines faster and at lower cost. That really helps. Obviously, size helps with that because you can get larger purchasing orders and lower unit costs. So I would go energy, kind of management of machines and purchasing of machines. And then, you kind of have general OpEx, which surprisingly, some people still manage better than others. So I think the cost side will predominantly focus on energy and machines or ASICs. And then the second aspect is, can you source cheaper cost of capital than your competitors? Because it allows you to grow faster and cheaper. Capital markets kind of factors into that too. So if you were based somewhere else versus the US, which has deeper pools of capital, all things equal, you're probably taking a hit in terms of cost of capital versus what can be offered in the US.
Yeah, no, that makes sense. It's a good description. It kind of gives people a lens into all these, how these businesses are constructed. Some of them are more vertically integrated than others. Some rent out their infrastructure data center space. Others own it and build it. And across the mining ecosystem, kind of just talking generally about the public players, there is quite a bit of dispersion. And I think, so from a high level, we'll dive here into the AI HPC story now, but just kind of to summarize, it's like, you have this arms race across the Bitcoin mining space to, it was extremely profitable in 2019, kind of pre-2020, 2020 halving hits, kind of the first real meaningful deterioration to profitability. Then these businesses were basically incentivized to start mining as much as possible, bring as many machines online. And in order to do that, secure as much infrastructure, data center capacity as possible. And a nice thing, unlike maybe certain kinds of compute requirements, for Bitcoin mining, you just want the cheapest cost capital. You don't need proximity to an urban center. It doesn't need to be right on the outskirts of New York City where power is going to be extremely expensive. So you find these miners are scattered, kind of in the most random places, nooks and crannies that have some stranded renewable power source like nuclear or upstate New York or some of these things, hydro. And then, obviously there's a bulk in West Texas where solar wind there's a huge excess because, the kind of environment out there is able to produce without, as much usage or demand for that energy. And, because you can't transport energy, 10,000 miles like you can gold or oil. So, there's obviously developments on that front. But so basically, we used to be really good businesses. 2020 kind of trend was the turning point. 2023, kind of very difficult businesses to run. Profitability was very weak. All of these players' access to capital got cut off. I mean, for me, they were always my favorite short because if Bitcoin wasn't going straight up and to the right, they just bled because they negatively cash flowing assets that needed to constantly issue shares. And even if Bitcoin's price just stayed the same, they're bleeding cash left and right and it dumping shares in the market, and their stock prices really fell because of it. So that, it's a similar kind of, I'd say, skepticism across Bitcoin miners as gold miners, right? It's like you look at the chart of gold, the asset, has outperformed gold miners for consistently for many years. And I'd say another point of that is just the periods where gold, or in Bitcoin's case, Bitcoin does well, is where there's inflation. Yeah, you also expect inflation to increase the cost of capital. Interest rates are higher. These companies are very capital intensive. They need more capital, and that becomes more expensive. So, anyways, real tough businesses, but they had this huge asset of power connectivity to grids and unique sources at low cost. Some of them, long-term contracts that provided this cheap energy into the future, at a fixed rate. And then here comes this, probably the biggest secular technology innovation of all time, or at least our time, AI and computing requirements to support that. So maybe from just a high level, and why I think that the industry has this, say, taint to it, is they were, a lot of them, left for dead businesses. It was there wasn't a clear path out of a very troubled, gross margin and cash flow picture for just about every miner until this AI story kind of comes about. So maybe dive into, like, just one, how it came about, the opportunity for them, why them, and maybe just this mismatch between AI computing demand and power.
I think we can start very high level from a macro sense. So we'll bring back the table stakes of supply and demand, and then we'll get to the actual Bitcoin miner side. So focusing on AI demand for power, you have an exponential wave of compute demand, given, as you said, like the rise of the AI era, one of the largest generational shifts in kind of technology. And we're still refining a lot of the use cases. But for many large companies, especially if you're big tech, like being at the forefront of AI is a must. There are these kind of ROI discussions that are ongoing. You saw like the Sequoia post, a lot of back and forth on, hey, is there ROI on all this AI spend? I think for some companies, there is clear ROI, especially if you have like vertical integration, like Meta. But even that aside, I think what's most powerful is like the Nash equilibrium, so to speak, as the motivating component. So you're kind of sitting there as a CEO of a large tech company. If you don't push forward and completely understand how to incorporate AI into your business and your products, your competitor is going to do it. And so even if your ROI, it gets like boxed out because your competitor does it, you have to do it because they're doing it. Else you're going to be left for dead. And so there's a lot of pressure on these companies to push into AI. And where have you seen this the most is the big tech spend. So you have around, I think it's like, so 50% of AI CapEx spent this year was from the big tech companies. And that's roughly 222 billion is the approximate for 2024. That's going to scale to 270, 280 next year, and then 340 billion in 2026. So we're talking mega dollars. Now, this is in the form of investments in data centers, human capital, new equipment, but the big prize within this CapEx investing is chips, right? And to the massive rise of NVIDIA over the past several months, or even a couple of years, AI demand equals chip demand. So NVIDIA has been growing its data center revenue quarter in, quarter out at a pretty phenomenal clip. I think the recent Q2 earnings was like up 154% year over year versus the quarter this time last year. And that's like 26 billion. And according to people that are close to the company on the investor side, they're thinking that growth is going to continue on this basis into 2026. So we're not talking about something that's pretty temporal. So you have all this money, all these chips being built up, all this investing happening. But I think one of the biggest questions of 2024 is, you buy all these chips, like, where are you going to plug them in and use them? And that's how we get to supply. So we'll put a pin in demand for now. So to pursue what we call AI compute requires a tremendous amount of energy. And you need to train these models with chips, and they just devour energy. But you may think, okay, that's fair, but we're a very capable country, human race, et cetera. We just plug them into data centers. Okay, so that's door number one. All right, so we look at the kind of data centers of today, the big guys like Equinix and Digital Realty. Can we plug them in there? Well, there's a couple of issues. One is, if you look at the vacancy rate across primary markets in the US, it's like 1% to 2%. So everyone already has seats at the table. You're trying to run in to plug in your chips, there's no space. And you can maybe say, all right, just kick off those customers. AI companies will pay 5x. Well, they're generally multi-year contracts. So now you have this issue where people are dining at your favorite restaurant for several years. You can't get a table. The second aspect is until 2020, most of these data centers were designed with like a CPU architecture in mind. AI chips are GPU based, have tremendously different energy requirements, especially in like rack density. And so even if that table is open, you can't effectively do what you need to do on the AI compute side, especially when it comes to training, as you could with a GPU kind of architected data center. So the basic construction and design and the way things work is suboptimal. The third point with why you can't use these old data centers, door number one again, is a lot of these businesses are very levered. Management is not in the best position to go out and take a big project that is going to cost billions in CapEx. They, of course, are trying to position themselves in some ways, but the fact of the matter is they can't afford to go and add a bunch more debt and do this, at least within the time period required. So, okay, we can use the old data centers, but you might say, don't worry about it. The US is going to build a bunch more next year, so we're good. Well, sadly, we're not building nearly at the pace that we need to. There was a recent Morgan Stanley JLL report where if you look at the US data center power demand that they expect over the next couple of years, it's like 11 to 14 gigawatts. And the supply of data center construction right now is 5 to 6. So if you factor in vacancy rate today and 11 to 14 versus 5 to 6, we're not making enough in terms of data center capacity to be able to take in all this extra demand. Okay, so door number two, we can't go and build a bunch next year. Door number three, let's say you're Meta and Amazon. You have a bunch of cash, you have very smart people. Okay, what we're going to do is we're just going to go and build our own data center. Nice and easy. We can do what we want. We're the biggest companies in the US. There's no strings attached. We can go in and do this. You find the right land, you bring in all the materials, you build up your data centers. But how do you actually turn on your chips? You need power. How do you get that power? You can't just plug into the grid. You need interconnection in most cases, right? And this is where a material delay resides. There was a neat study put out where they looked at the length of time required to connect into certain energy markets over the last several years. And in 2022, the average project took roughly 5 years from like pure, day zero to being able to be energized. Now there's some caveats, some are faster, some are slower. A lot of projects actually dropped off.
You think Zuck or Bezos are just gonna, 5 years? All right, we'll wait it.
Exactly. So definitely they're not. But it used to be less than 2 years before 2008. And this is like a macro issue with our power grid is it's not adapting at the scale it needs to accommodate not just AI, but streaming and all sorts of other heavy
electric vehicles
use cases. Yeah. So anyway, so door number three is not looking good either. So those options are like, okay, like maybe you can stomach it because, hey, the biggest argument that's given is, maybe it won't be as computationally intensive. We're just going to get very effective at training AI and it'll be like nice and easy. Well, sadly, that's not the case. It's very computationally heavy and it's only getting worse. So I'll give you one data point, which is interesting. To use like a high-powered chip like a GPU, so like you put them into nodes and they form racks, the rack density, especially for some of the newer chips, can approximate 100 kilowatts per rack. To put this into context, today, like 10 kilowatts per rack is very common, perhaps 15 to 25 to 30 in like a high performance, high density data center, but 100 is really up there. And you're kind of packing in a bunch of these racks to train, models that have billions of parameters. These models are only getting more computationally heavy. I'll give you another fact. I was catching up with someone at an AI cloud company, and they were assessing how many servers it took to accommodate a model over time. It used to be 2 to 4. Now it's 6 to 8. They expect 10 to 12 in the near future. And then over time, I think this is going to increase by a factor of 10. So you need more and more of these chips. They need to be at higher rack densities. TLDR is training is very energy intensive. And this is not good given the energy story we told before. But All right, let's say if you ignore all of that, what if you said, okay, we're going to do the training in the next 2 years, and then inference will be easy. So then we're good. So we just got to stomach 2 years. Maybe you heard like Sergey Brin talk about this. Yes, but I'm going to give you 2 caveats. One is inference is changing before our eyes. So the recent September OpenAI paper, which talked about like smart inference, saw it be much more computationally heavy than the prior kind of inference expectations. So the more we want to do with inference, the heavier it is getting in terms of computation. The second, and this is a cool stat that I got from a colleague, if you watch Jensen's GTC keynote, which was earlier this year, it talks about how Blackwell is like much better inference computing to the tune of 30x the throughput of prior GPU designs. But if you like dig into that, a majority of the 30 turns is actually coming from networking and the way in which these Blackwell chips are set up, aka this can't be done in a distributed kind of small device in someone's home. Inference will have to be done in data centers as well. So even if you get over all these hurdles, inference is still going to be computationally heavy and it's going to be done in data centers. So I'm going to recap all of that. Hundreds of billions flowing into AI demand and chip investments. These billions of dollars of chips are sitting there idle, right? I'm exaggerating a bit, but a lot of them are, with little space to plug them in. It takes years to get access to energy. It's only getting more and more computationally heavy. So I pose a question to the viewers. What if we found these energy-intensive computing sites that can be repurposed, right? They need to have long-term available power, some good electrical infrastructure, and high-density capabilities. Sounds familiar, right? These are Bitcoin miners. So I'll stop there.
Hey everyone, this episode is sponsored by Polkadot. Out of the 500 protocols, one of them is called Origin Trail, and they're building a verifiable internet for AI, ensuring the provenance and verifiability of data to tackle challenges like bias and misinformation in AI systems. Used by global leaders like the British Standards Institution and the Swiss Federal Railways, Origin Trail is vital in sectors like asset tokenization, healthcare, and the metaverse. Powered by Polkadot, Origin Trail enhances the discoverability of crucial knowledge and secures information in the AI era. Power the verifiable internet with Origin Trail at origintrail.io. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, today's episode is brought to you by Mantra Chain. Mantra Chain's mainnet has officially launched, marking a major milestone in their journey to become the go-to platform for tokenized real-world assets. Designed as a specialized real-world asset Layer 1 blockchain, Mantra Chain paves the way for traditional financial institutions to enter the Web3 space seamlessly and securely. With a high-performance infrastructure that can handle both permissionless and permission applications, Mantra is setting the standard as the home of real-world assets. Plus, they're making waves with big partnerships like their $500 million project with MAG Group and a new collaboration with Zan Bank in the UAE. Mantra Chain is all about building a compliant, scalable future for asset tokenization. Ready to explore the future of asset tokenization? Visit mantrachain.io to learn more and see how they're shaping the finance of tomorrow.
Yeah, no, take a drink. That was informative. I think we could just end right there for how bullish the backdrop it makes me on this opportunity. I mean, there's a lot, like breaking down kind of all the different core tenets there is like starting point is you're going into a business with the best counterparties in the world. So when you think about it's pretty funny to think about, everything we just described about Bitcoin mining as a business, their difficult access to capital, investors really dislike the cyclicality and volatility in the business. It's probably like one of the highest cost of capital businesses you could possibly endeavor in public markets. Like they just don't have access to any debt financing. It's all equity financing because it's like zero or hero. It's like you're gonna, Bitcoin price goes up and you 5x because they're levered, or or the businesses like are worth very little. And you contrast that with this arms race going on in the AI boom is, as it makes sense, the largest businesses in the world, the multinational, multi-trillion-dollar enterprise value companies, your Mag 7 tech. To your point, like whether, I think if there's anything they've learned in the last 20, 30 years of their existence around innovation is like a lot of their businesses have been built, and are at, let's say, risk of, competitive loss
Yeah.
due to some of the innovation around AI, whether that's Google search and Perplexity, or, all these other tooling and software has been an area that in 21 was loved by, you had all the work from home and big software boom. And that's been kind of, let's say, dented a little bit from a narrative perspective, because you have AI that can now code and write scripts. And so, you have a lot of these businesses built on core tenets that AI infringes upon. And it's for them, there's all these new AI startups, but for them, it's like protecting their moats and protecting what they have, even in some cases more than competing in the new side. So it's kind of like a do or die, like for these large Mag 7s.
Yeah.
And you're seeing that, right? You're seeing that in their investment into the industry. And a lot of these, some of them have generated revenues and real sustainable businesses, but for the most part, it's been a lot of science experiments and
Yeah.
products that are not, let's say, delivering to their bottom line yet. And then, so you have that side of it, like the best counterparties in the world who basically in some cases borrow money cheaper than governments. I mean, some of these companies, have a lower cost of capital than countries. They're bigger than the majority of countries in the world's GDP. And you combine that with, you're seeing that in the numbers. What was the annual numbers? Couple $100 billion
Yeah.
in
Growing
investment.
to like 340 billion in a couple of years just from the big tech guys. I mean, it's
So
insane the scale.
so they obviously, it's a new kind of business for them that they're getting into. And maybe just to touch on the bottleneck, you're thinking about, okay, I want to build all these large language models and AI capabilities to put into my products and compete and offer new services. The first thing you mentioned, chips. That's like, I need to be able to run these models. What I guess, how do you envision the backlog for chips? Like, that's not the story here that we're focusing on. We're focusing on kind of the next, but that is the first bottleneck that seems, and it makes sense, this trade that if you say AI, everybody just knows NVIDIA, and, they've been the receiver for the most part of the CapEx. Like if Ram Aluwalia has been all over this for the last year, is like, I want to be invested in the receivers of the AI CapEx versus the Googles who have to spend it, or he likes Google, but like some of the other, the Apples who have to be the spender of all the CapEx to compete. And so maybe talk about like just a little on the chip story and like, if you're telling me they don't have the space and electricity to plug the chips in, like why is there such a backlog? How are they ordering and paying for all these chips if they don't have anywhere to put it?
I think the first bottleneck was the chip side, which explains NVIDIA's meteoric rise. There's this cool book about like supply chain management called The Goal. And it's like you have to find out where the bottlenecks are to like, streamline your supply chain. And my thesis is the bottleneck is shifting down from the chip level, these AI cloud providers, to access to power. So they bought all these chips. How can they do that? Well, thankfully, in the financing markets, everyone loves AI. So a lot of them actually secured tremendous amounts of debt and equity financing by the AI story, debt collateralized with these GPUs to go out and buy all of these GPUs. Of course, if you're high quality hyperscaler, you can just use your massive cash balance, and to your point, even get phenomenal financing if you need it. But they're all buying these GPUs. I mean, you even saw venture firms buy GPUs to like win deal flow. Like everyone wanted GPUs so you could train, because that's the first step in this AI race. Is you need to train. You want better and better models. People are kind of come addicted to like training and improving. But I think there was a, not short-sightedness, but an underappreciation for how capacity constrained our grid and data center industries are in the United States. And that's why you're seeing the shift in many different ways to energy being the bottleneck, right? You've seen, I mean, 3 Mile Long Island was being discussed to be opened up. Like the demand is so palpable that someone's willing to go to the extent of trying to revive the United States' worst domestic nuclear disaster just to get access to power. I'm exaggerating a bit, but that's kind of true, right? Like you saw Talon, you've seen, all sorts of absolute increases in demand in nuclear companies and in utilities. It's like you're seeing it occur because here's the deal: is you bought all these chips, or you have all these chips in process, and NVIDIA is in backlog for several quarters ahead. So people are still doing this clearly. They're sitting there depreciating, one. So you have a lot of pressure financially. But the biggest pressure, back to the Nash equilibrium, to what you said and I said, your competitors, maybe some of them did get energy access, are now training their models at a faster rate than you. And like it's like an exponential function. Like it truly, like once you're behind the 8 ball, that's it. You're done. So there is this tremendous pressure to get these chips into motion. So much so that these AI cloud providers are willing to go and pay for the CapEx and help whatever industries that have access to energy kind of get it online faster, because the time value of money is the most important factor, even more so than the cost. And they can access this financing, again, because there's so much demand in the debt capital markets and equity markets to want exposure to the steam. So they can get the money. The trick is, can you get to the energy? And the most important trick or question is, can you get to the energy next year? Because 3 years from now, we'll solve some of these bottlenecks. But in 3 years' time, your competitor is already going to be way ahead of you in terms of their model. So you have to get access to it like now. That's the key qualifier. And when you add the now, the picture does not look pretty, because when we walked through before, a lot of the space is all taken up, and you have to wait several years to try to get into it. So that's why, these Bitcoin miners that have these power contracts in size, right? And we're talking gigawatts, not like 2 megawatts here and there, can provide that access. Whereas before, it was hard, it was a scramble to get into that. So there's a fascination on the capital market side with the theme. That's how they get the financing. That's how they get the chips. NVIDIA is now coping much better from a supply chain standpoint. But the problem is where you're going to plug your chips in.
No, that makes sense. It's kind of wild. So it's like, it's truly the definition of an arms race, because you have these products out in the public, whether it's GPT, Claude, Bart, everybody's got their large LLM. You're seeing these LLMs being integrated into every sort of product possible, software and different technology services. And, that gives you a good sense of the demand and really, I don't even know, demand is like consumers are yearning for, but it's this innovation. I'd say consumers probably don't even know what the best use or AI product's going to be just yet. But the companies, the richest companies in the world who produce billions and tens of billions of dollars in cash flow per year have basically assigned this as their number one task to go after. Yeah. So they've got the chip solved. That's a good point on the NVIDIA front is the backlog for NVIDIA's chips just to provide these GPUs is many quarters out, which is saying, all right, like these hyperscalers are receiving chips deliveries and orders that they probably can't even place today. And, NVIDIA's contracted out with down payments to some extent for quarters on end. So you're going to have kind of chips up to your eyeballs at some point. And then, like you said, well, am I going to let those depreciate on my balance sheet because NVIDIA is cranking out newer technology and newer chips, higher computing times every year, or am I going to pay a premium to deploy it and make sure my business exists in 5 years from now? So you get all that, and then obviously that brings us to the miners, who, as we mentioned, happen to be the largest aggregators of power purchase agreements, infrastructure, and grid connectivity in the last 5 years. So it's like this. It's fascinating to me, like how perfect of a storm, because there's the businesses like a CoreWeave who was in it. I mean, even NVIDIA was in and around crypto with on the Ethereum side, CoreWeave, they knew, I spoke to that team years ago. They've kind of seen Bitcoin mining as a difficult area, and they were doing things around Ethereum and other compute GPU related. But even for everyone, really, to some extent, right? This particularly the miners, I think CoreWeave saw it coming, hence why they're so well positioned. They're the darling. They're gonna probably, the news just came out that they picked their IPO advisor. They're probably going to go to market. I don't know, guessing, but probably Q1. And then the miners were kind of just, even some today you're seeing it are not embracing it, which is interesting, right?
Yeah.
Why would a miner, I think it has to do with how their business set up if they actually can't even pursue AI, but why would, from your perspective, some of these miners not just even throw out the Bitcoin mining side altogether if it's not profitable and just kind of focus solely on this?
I think there's two strands. One is the philosophical one. I do think some of these mining businesses are run by Bitcoin maxi type people who have built their image, their identity, everything on Bitcoin. And it's like, even if, and we can get into why I think this business kind of structure is so much better from an enterprise value standpoint than Bitcoin mining. Even if that's the case, they're going to stick with what they want to do. I think candidly, a lot of them just don't actually have the correct characteristics facility-wise to accommodate what hyperscalers really do need. Like there's a nice, Venn diagram of like AI qualifications from a compute standpoint and like Bitcoin mining sites. And I think some of them just don't have it. I think a lot of them are trying to say they have it that don't, is my personal opinion. And maybe there's some that are just honest. They're like, look, like we literally don't have the correct sites. We probably definitely don't have the capabilities. So we're gonna sit this one out. But I think in a weird way, the philosophical one is stronger because I think there are sites within some of the philosophical ones that could be interesting from an HPC standpoint. Yeah, it's weird. I think it's more so the case that we're seeing a lot say that they are ready for this, when in fact, they don't actually have the power access today, or the power access is in a region that isn't friendly to what hyperscalers are looking for, or they're like chicken coop facilities. So like we need to distill exactly what type of site makes sense, and not all the miners have those sites. And then I think human capital is really critical. Like some miners have really good data center teams. And so if you're Google, yes, you want to move fast, but like you're not going to spend billions on people that kind of, just talk on crypto Twitter and pay like people to just run mining machines that don't actually understand how to run a traditional data center. So there's a human capital advantage that some of the teams have. And then I think, to backtrack, an interesting angle into the Bitcoin side is like when did this become obvious, or how did this originate? And I think, at least between you and I, when we started chatting about this in June, it was that CoreWeave Core Scientific deal, the first one, that kind of started to bring this to light. Now, there were some signs earlier than that. Core Scientific actually had a small facility in Austin that it was doing this with a couple quarters before. But the fact that you had a well-capitalized AI cloud business willing to pay for all the CapEx and kind of provide this capital up front to get access to this power was like a testament that there's something going on here. And the fact that they picked a Bitcoin miner that had, specific types of sites meant that, hey, maybe these Bitcoin miners really can provide what is in need here. And I think, why is this interesting from investor side? Because this is kind of the main theme of this podcast, I guess, is back in the summer, you were looking at, the average Bitcoin miner traded at $2 to $4 million of enterprise value to operational megawatt, right? And you're thinking, all right, if this Core Scientific CoreWeave structure is replicable to some degree, that 2 to 4 looks very different to the 45 million enterprise value per operational megawatt that data center REITs trade at. Now, data center REITs have specific tax advantages. They're more diversified customer base. So this kind of differential by a factor of 10 is somewhat explained by some aspects, but you kind of start to think like, wait, there's something here. The 16 million per megawatt build cost, the 20 to 30 million megawatt precedent transactions, like something's a little off. So I think, at least personally, I started to call people up in like Bitcoin mining and data centers. I actually spoke to a data center build out lead at one of the hyperscalers, and I kind of presented the situation and I asked them, hey, like, is this conversion actually possible? Now we like walk through the chicken coop stuff. A lot of these companies aren't well run. The sites actually aren't that good. But once you like got through all of that, for the right sites, yes, it is possible to retrofit them to AI compute at a cost that is lower than like fully building it up from scratch. And then it's like when you add on, hey, these have access to power already, it's like, whoa, that's actually very interesting. So yeah, that's kind of, the origin of perhaps more people being interested in this theme. We discussed kind of why some miners don't do it, but why should some miners do it? I'll give a quick response. I'll pass it back on to you. HPC just flat out, like HPC AI compute, represents a materially better business profile. Your contracts are like 10 to 15 years, so the revenue visibility is strong. Your counterparties are much less volatile than the Bitcoin network. You have a higher margin business on average, and you can actually look at some of the deal terms of the CoreWeave Core Scientific deal. They're public, but they expect 75 to 80% margin. And you have a really strong secular growth kind of tailwind of this whole new AI era, to how we started the conversation today. So you're making money in a more predictable fashion. You're making more money in a lot of cases relative to, depending on kind of how hash price goes, but in a lot of kind of simulations, you're actually making more money. And then your ability to finance this is materially better, right? Talking about the capital market stuff we said earlier, you can now get debt at like SOFR, plus 2%, because these are more predictable revenue streams with higher quality counterparties. So you improve your cost of capital structure. And yeah, those things all make it very interesting. But the one caveat, and we can get into this, not all Bitcoin miners are able to do this. There are characteristics that determine site suitability. And sadly, the world's not a place where everyone has everything. Like most of the miners don't have the right sites, and they don't have the right sites plus power and fiber requirements today.
No, that's a great rundown. And I think the points you made about sifting through the noise here is really important, because that's another beef historically that traditional investors have had with the Bitcoin mining, I'd say, public company ecosystem and investable universe is what's real here. You had, I would say, what's actually happening and what's represented as being happening, or what's possible. And obviously everybody's trying to, as a management team's trying to sell the prospects of their business. And but you've had in the past, at least historical, in some cases, large discrepancies between what's promised, what's delivered, and what was even feasible from the get-go. And so I think, for some of the teams in the ecosystem, particularly probably ones that were more just early Bitcoiners and not, actually infrastructure, energy, power, data center people, there's a lot less execution than would have liked. And people lost a lot of faith in a lot of the companies, just broad strokes, because they felt that they couldn't trust a lot of the management teams. And so, you mentioned this transition to the AI side is not everyone's created equally, and it stems kind of from the Bitcoin. And I would say generally, we talked about what makes Bitcoin mining successful is just really at the core, cheap, access to powered, unlimited, higher amounts of access to cheaper power on a contracted fixed rate basis, and then if you have that, you can kind of build onto the infrastructure side, or at least have a much more fighting chance to bring on the human capital, intellectual talent required to build out. So I'd say a lot of the core tenets that made the miners good probably carries over. And, I think it's interesting to see, what this can amount to. So just maybe on the core scientific, CoreWeave side, we're not going to get into individual names or recommendations. We're just kind of, the goal of this is to lay the foundation for people to better understand this broader thesis and the opportunity that exists. But just using that as the example, because it's the most public, transparent, it's been out in the press numerous times. what is the actual timeline on something like this? It was announced early summer, and obviously Core Scientific is a very large Bitcoin mining operation already in existence. Like maybe just the very high level. We don't need to go too in the weeds on a single name, but just like what this retrofitting process looks like.
It's a great question, and I think it hits home at, again, like the underlying just crux of this thesis, which is the time of getting to power, right? Core Scientific's first 200 megawatts with CoreWeave, according to the management team, which they've reiterated multiple times, should be live and energized, operational by the end of the first half of next year, right? So when we think about the data center occupancy, the years of interconnect, it starts to become more apparent why CoreWeave structured a deal that was favorable to Core Scientific, because that 1 year is materially better than like other directions available for them. And so the fact is they what are they going to do? They're going to essentially tear down the facilities they have now. They're going to leave the critical electrical infrastructure like substations, transformers, etc. They're going to rebuild alongside CoreWeave's designs. Like they're working a lot as close partners, an AI specific data center, and it's going to have the PPA, the electricity, all that in place already, and then they're just going to launch it live, making it really simple. But this is all going to happen within a year, which is phenomenal. But I think it points to, again, the crux of the thesis, which is they can do that within a year because they have the access to the right electrical equipment and power contracts. Core Scientific, as a company, has really high quality people on the data center side, according to kind of industry experts. So the human capital they have to execute this is much better than the average Bitcoin miner. And then in terms of the other characteristics, they have the fiber redundancy, their geographic locations in terms of disaster risk, urban proximity is really good. And this was in part because the way they set up in terms of site acquisition was to focus on going to places where high quality or high performance data centers could be run. So the fact of the matter is these types of sites were set up in such a good way from a characteristic standpoint of location, access to resources, the electrical equipment, that you could pull it off within a year, whereas a complete like greenfield project would take much longer. And again, like just to reiterate, and I don't mean to say this so many times for the viewers, but the time value of money is critical. The fact is that CoreWeave can now start executing on its compute roadmap much faster than competitors in terms of the scale, because they can access these 200 megawatts, and they kind of iterated in terms of several extensions of that contract with more megawattage, but they can do that within a year now. And I'll throw out a number. Both Morgan Stanley and JP Morgan actually put out these theoretical frameworks. So you have to caveat it a bit. That acceleration of 1 to 3 years in terms of access to power and getting AI compute online is worth millions. I think it was like 8 million per megawatt was what the Morgan Stanley report said. It just gets back to like this 1 year timeline is very, very impressive. And that's the reason why CoreWeave is working with them, is that Core Scientific is able to pull off this 1 year time horizon.
That makes a lot of sense. I mean, it's remarkable. And Core Scientific, obviously, in tandem with CoreWeave's kind of been leading the way. You look at these businesses we mentioned; they basically have no access to attractive capital. They finance themselves just issuing shares in the equity market, and really it's reflected in their share price. And then CoreWeave comes along, who does have tremendous access to capital, but one of the reasons they're going public is probably to improve their access even. Because it's, again, very capital intensive for all parts of this supply chain, and they basically the demand is so high that they're willing to finance and use their balance sheet basically to help Core Scientific, get to market quicker. So I think you hit on a lot of the key points, and we touched on it briefly how there's this dispersion, right? It's not an industry to be flying blind in, because there's real differences between the companies that can actually do it. Maybe some can do it, but on a 3 to 4 or 5 year time horizon.
Exactly.
They don't have quite the existing setup. And on that note, like, what would you say are some of these risks? Because people are going to come away from this looking to diligence this further, trying to dive into some of the names, they might potentially like. But what are some of those things they should be, looking out for as potential risks
Yeah.
that could disrupt this?
I think a couple. One is just execution. So are you able to go out and convince a hyperscaler to work with you? Are you able to get that contract signed and then go and build a very complex piece of infrastructure and run it at extremely high SLAs? Not many teams, to our earlier points, have the capabilities to do this. And it's not like you can go and hire these people because they're some of the most in-demand people right now. So just really understanding who are the people behind these companies and what teams do they have is critical. The second is, all right, do they actually have sites that, one, are energized today? Because it's easy to say, hey, I have a 500 megawatt site, like I did some interconnect studies. Oh yeah, so like when can you turn the spigot of energy on? Oh, 3 years from now. Okay, well, that kind of doesn't make as much sense in the context of why this is valuable to hyperscalers. The second component is, where is your site? Oh, it's like out in the desert, far away from everything. There may be an ISP somewhere nearby, but I don't know. All right, so no access to fiber, terrible proximity to an urban center. Like, the characteristics of these sites are critical. So understanding, are the sites prime for this type of retrofitting is the second component. And then you start to get into like the actual execution risk of signing a deal, right? Which we have to applaud Core Scientific for, because they went and they did that. There's no other team that has done that at the scale, megawattage wise, that Core has. Can you sign a deal? Can you sign it with a high quality counterparty that's not going to just go bust next year because all their revenue is from AI startups that are seed stage, right? So you got to like look through at who their customers are, and are the deal terms that you're signing for this contract favorable, right? Like the long-term revenue visibility is key. The pricing is key. Does it come with a prepay? Like, that's phenomenal. The fact that there is this CapEx investment and a prepay that allows Core Scientific to get up on the ground. Like, you want these to be part of the deal, because no matter how you look at it, you're going to have to scrap most of the Bitcoin mining stuff and rebuild the whole facility. And that costs a lot of money. So the terms are another one. And then how are you going to finance that is related to the terms, right? Some of these businesses will still keep issuing a bunch of equity. Others will get pretty favorable debt financing at like 70% loan to cost. I think it's like SOFR 2 to 4% for some of these construction loans versus just issuing a bunch of equity. So execution, human capital, quality of sites, and the actual deals themselves would be 4 areas that I look into. And then that's all overlaid with like, again, are these high quality people? What are their backgrounds? What is their track record as stewards of capital? Those are important as well.
Yeah, it's complex for sure. I mean, it's extremely beneficial if you're a Bitcoin miner to kind of slot yourself into this narrative, because obviously you're looking around and you see a pretty drastic year to date kind of performance across the different businesses, and so really diving in, some of them may have gotten re-rated higher but might not have as much actually behind them, and others there might be more like hidden gems. So I think it's important, people are doing the research on your, and maybe the other topic, I think people are looking at this, and so we've painted a pretty attractive case for why the revenue and cash flow business opportunity for these miners to kind of switch. I think it's interesting to think about in terms of both, there's an uncorrelated or generally, there's some correlation, but less correlated return stream here from the AI HPC side versus just the historically volatile Bitcoin price. So you can kind of project out the demand, as you said, that you're not reliant on market forces for your revenue, and aka the price of Bitcoin. And so as we're moving to a potentially very supportive, macro environment, Bitcoin just kind of broke out of a very, like 10-month range. And traditionally miners, just Bitcoin miners have done really well in periods of rising Bitcoin price. So on the one hand, it's like there's a floor valuation if they're able to execute on the A side, but you still in many cases have this Bitcoin exposure, almost like an embedded call option to the price of Bitcoin, where they might be based on their profitability for mining, moving more slowly or more quickly towards transitioning to AI. But do you think over time it's possible that some of these just ditch the Bitcoin mining altogether? Like, is it something like having the flexibility to turn on and off your Bitcoin mining? Like, how do you kind of see these businesses evolving into the future?
If you structure things purely first principles, understanding what capital markets are looking for. So if you're like John Malone and your North Star is delivering value to shareholders, I think there is a fair argument to be made that if structured accretively, you build out your HPC side and then you divest out of Bitcoin mining. That may upset some of the crypto purists, but again, pure kind of shareholder value perspective. What you would do then is, there's still this taint amongst institutional investors on Wall Street with the Bitcoin mining side, explained by the points you brought up earlier. It's like some of these companies will still be dinged a bit, even if the HPC side is going well. So if you can make it a vanilla data center player, and then you work on making that a REIT, so then you start getting these tax advantages, and then you can lever it up much better. You can build like a tremendous amount of shareholder wealth, in my personal opinion, by doing that. And that does entail divesting the Bitcoin miner side and making it a very clear-cut AI HPC data center play that's a REIT. So I do think that's from a first principles way, like if you're just focused on shareholder value, like what should be done. Now, the reality is there's other pressures on these businesses, on the management team. And at the moment, especially the allure of a positive macro year next year for Bitcoin, like they want to keep that call option, which does provide value if hash price bumps up and hash cost kind of stays the same. But again, it gets crowded out to earlier points. Then you want to keep the Bitcoin side. The other fact of the matter too is, some of these companies may only have one or two really good HPC sites, and it's like you're going to actually reduce the size of your company, which people traditionally don't like doing, if you get rid of all the Bitcoin mining. So I think there's some of these factors at play. There's just also like path dependency. A lot of these management teams, they just know how to run Bitcoin mining, and it's kind of scary just getting rid of all of that, especially if you don't even have an HPC contract. But assuming shareholder value was what you wanted to do, and you secured the contracts, you had the right facilities, the right people, I think making it a pure play, wrapping that in a REIT, getting better financing in terms of leverage would allow you to create a tremendous amount of shareholder wealth.
Yeah, no, it makes sense. It's interesting, and over time, I'd expect the clear leaders to probably, ultimately that's capitalism, so they probably take that route. But you, as you said, you do forgo some of those other things, and it's a cleaner story. It's one of those cases where traditional kind of financial engineering or capital structure management, where the sum of the parts in these cases are kind of more than what they're trading at, just because it's a hairier story, and you're introducing other sorts of execution operational risks. One of the arguments you could make is prior to the recent election outcome, there was maybe more regulatory pressure on the mining business. So if you're a traditional, big investor looking at the space, you're like, well, I want to buy this into this data center AI HPC story, but I don't want one day, the US government, Biden, Warren, to like come down and say, wreck all companies that partake in Bitcoin mining. It's just, one of those funny, talking points for politicians no one talks about the AI compute demand side for energy, which is like, multiples the size of Bitcoin mining. They just point at because Bitcoin's crypto. So, but I think as you point out, like over time, the pressures from shareholders will probably shift a lot of these business towards that. No, this was super, super informative. I think I'm really excited about it, and always love having these conversations. And I think it's going to be useful content for people. What would you, anything you want to end with, Josh? Thanks for indulging us.
Yeah, I enjoyed it. As you can maybe tell, I'm super passionate. It's a gift in some ways to our industry. It's a very interesting combination of AI and crypto in a way that the crypto people maybe didn't understand as much. So I think it's something to definitely keep an eye on. if you're very interested in this topic, feel free to reach out to Quinn or I, because we spent a lot of time on it. And yeah, I appreciate you having me.
Yeah, no, thanks for having us. People can tell you spend a lot of time. I know personally, you're my AI Bitcoin miner quant. So thanks for sharing with us.
Sure thing.
Cool. Have a good weekend.
You too.
There's over 500 protocols building on Polkadot, and one of them is called Polymech. Polymech is a decentralized, community-driven funding protocol on Polkadot, enabling regulatory compliant and transparent fundraising of Web3. Polymech ensures compliance with a novel KYC AML process, facilitating a trustless and automated funding process from fundraising to token distribution. By removing intermediaries, Polymech offers accessible, inclusive, and transparent funding opportunities for all participants. Powered by Polkadot, Polymech is redefining fundraising in the crypto space. Explore how to become a Polkadot VC at polymech.org.